Hope everyone's doing well and had a good day. This is the Emini review for Wednesday, June 12th, 2024. And today was an FOMC interest rate decision day, and that's at 2 p.m. And so in general, for days with the FOMC reports, the market's usually more quiet, more sideways leading into the report, and then there's usually volatility expansion right at the report time. But in general, really, in any news event, I don't pay any attention. I just watch the chart. Overall, today was an interesting day, and I'll start with the daily chart. The market's been sideways in a trading range, and some traders might view it as an expanding triangle. You can see we've gone down and up, maybe 3 or 4 legs. And so the concern right now for the bulls, we're getting a bull breakout above all the bars to the left. And that was in the form of a gap up coming into today. And then look at today. It's a disappointing bar. Even if today closed above its open, which we're still in session, it looks like we are rallying in the final few minutes. But even if it does, it's a disappointing entry bar. It's a doji. The day rallied and then pulled back. So it would be bare minimum follow through for the bulls, but the context is bad. It might be 1, 2, 3 buy climaxes in an overall trading range. We're getting far from the moving average on the daily chart, but the one thing the bulls have here is they're accumulating bull bars. Look at the selling pressure all through here. The bears have had 2 closes, neither of them strong, both of them above their midpoints. So the bears are still going to have to do more to reverse this, but the upside might be limited. The bulls are hoping it's a bull breakout. We get maybe a pause bar, a pullback, and then continuation to the upside. The bears, like I said, they need to do more, but they're hoping they can prevent the bull breakout from succeeding, disappoint the bulls enough so that more and more give up, maybe create a second sell signal, and then we fall back into the trading range. On the 5-minute chart today, we had a very big gap up. And I'll normally draw, for these end of day reviews, I'll draw yesterday's high and yesterday's low, but neither one was tested today. So here's bar 1. We gapped all the way up here. The gap up was almost 1%. It was about 45 points. And that's about the average bar range on the daily chart recently. So it's a pretty big gap up. Bar 1 was a bear bar, but it's a small bar, and it's not enough to reverse the gap. You can think about the gap as a breakout, and there's an increased chance we're going to go higher. We're going to go in the direction of the gap. But bar 1, it's disappointing. But again, not enough to reverse this. Probably buyers below bar 1. Bar 2, a breakout bar. It's a bull bar closing on its high, but almost entirely overlapping bar 1. So it's a 2-bar trading range. But again, in this case, the probability is on the bull side after the big gap up. Probably going at least a little bit higher. Might be stop order bulls buying above bar 2. And if we trade below bar 2, probably buyers below as well. It's a bad sell signal bar. And then a little bit of a surprise on bar 3, bull breakout, consecutive bull bars, both closing on their highs, one being big. And by the way, coming into the day with the gap up and bar 1, it was probably always in long. And if it wasn't clear, it's clear now. So always in long, bar 3. Consecutive bull bars, you can buy the close, buy for any reason. Okay to be long. But you have to recognize that we're really far above the average price, which is all the way down here. Now it's going to catch up eventually. Something like 99% of days have at least one close below the moving average, maybe at least 3 lows below, even if it's a small pullback trend day. But the moving average is going to catch up to the price, whether we go sideways or down. But being this far above the average price, traders, if they're going to pay this far above average, they want above average bullishness. And so far, this is pretty good. and follow through on bar 4. So 3 consecutive bull bars, micro channel, strong enough breakout. Maybe it's leg 1 on the gap, leg 2, maybe this is a leg 1 reset. But either way, this is strong enough for the first pullback to probably be minor and lead to a second leg. And then a bear bar closing on its low, bar 5. The problem with a bear bar closing on its low, well, there's two things about it. Like I just said, this is strong enough that it'll probably get a second leg, and the first pullback is probably minor. And the fact that it triggered below a bull bar, bar 4, damages the bear case. There's probably buyers below bar 4. But bar 4 is a decent bar. The problem is that it's not very big, and there's momentum to the upside, so probably going at least a little higher. The problem for the bulls with bar 4 is that we're so far above the moving average that it's reasonable for bulls to exit below a bear bar closing on its low. But if they do that, it's still always in long. At this point, they can enter again above a bull bar closing above its midpoint. And instead of triggering, the bulls prevented that from triggering. It's the first pullback or pullback attempt. We did pull back below bar 4. And then the first strong bear bar today, they bought it. Bar 6, bull breakout bar, but closed within bar 5. And now the past 3 bars are a tight trading range. We might start to go more sideways here. Bull breakout, pullback, we might start channeling up, but channels evolve into trading ranges. So at this point, we know that bar 5 is a magnet and will probably get retested later in the day and act as support. Another bull bar on bar 7 broke out above bar 6 by maybe 1 tick, but could not close above. Strong enough breakout for a second leg. Is this a second leg? Probably not. Probably be a little more symmetrical, even if it's not a full leg 1, pullback leg 2. This probably is not enough. And again, the bears just don't have enough selling pressure. This is not, even if there's a bear bar, bar 8, the bears need a good entry bar to convince more and more traders to exit. There's only been 2 bear bars so far today, and the bull bars are fairly strong. And then bar 8, an inside bear bar. And the problem with inside bars is that the breakout probability is reduced. Breakouts of inside bars get tested within a couple of bars, and it's contracting. It's a triangle on a smaller time frame. And right here, we know that we have a big gap up, and then another bull breakout. More likely, this is a bull flag. Now, it might be a tight trading range and a final bull flag, so the next bull breakout could be the last one before we convert into a trading range. And then you can see we tried to break out below bar 8 and immediately failed and turned up on bar 9. But bar 9 is an outside bar, and the problem with bar 9, I have a couple problems with it. Some traders will view this as 3 legs up. Up on 4, up on 7, and up on 9. And bar 9 is an outside bar, which is an expanding triangle. It's a trading range on a smaller time frame. So if you're buying above bar 9, you're buying high in a trading range, and it's possibly a third leg. Remember I said bull breakout, pullback. This is the start of the channel phase. Market's channeling. We'll probably go at least a little bit higher, but the upside might be limited. And then 10, we're going a little higher, but 10's a much smaller bar than bar 9, so it's fairly disappointing for the bulls. Now it's possible we have 1 leg, pullback, and then a second leg, where the second leg subdivided into 2 smaller legs. Bar 10 is a weak sell signal bar, so there's probably more buyers below bar 10. But at this point, the bulls have had 2 legs up with a nested second leg. We're far above the average price, and it's reasonable to exit below a bear bar closing below its midpoint. Part of the reason for that is that we're so far above the average price. Bulls might not want to pay this far above average when they're expecting a correction, and they know that they can buy lower and possibly at the moving average. Another bull bar, bar 11, but even smaller than bar 10, The bodies are shrinking. The momentum is fading. On some smaller time frame chart, this is 3 pushes up. Really hard to see here, but there's small tails on 9. Below 10, 1, pull back 2, pull back 3. Bar 11 overlapped bar 10 by probably 85% or even more. That's a warning we might start to go more sideways here. And then 12, bull breakout, bigger than bar 10 and 11, which might be a little bit climactic. It's also basically a shaved bar, and that's parabolic. Whenever you have 4 or more bars, and then suddenly the last bar is increasing in velocity, you know it might be parabolic. And when you consider the context, what I've been saying, leg 1, pull back, leg 2, this is a more symmetrical second leg. So you might have bulls taking profits here. This might be a vacuum test of resistance. And then a pause bar, 13. It's a high 1, but possibly buying at resistance. Let me draw the leg 1, leg 2. So here's leg 1, pull back. You can see exactly where we're testing. And so that's one reason why we might be pausing. That's also a reason why bar 12 accelerated. If traders see this magnet, it might be kind of an obvious magnet. Leg 1, leg 2 is common. And so if we're here, the first reversal down, probably going to fail. Bears know that, bulls know that. Bears know they can short higher, so they'll wait to short. They'll pull their limit orders. And the bulls, especially something like a high-frequency trading firm, they're scalping ticks all the way up. They'll buy all the way up. And so we get this rally, but then we get a pause at the resistance. So pause bar, high 1, but a doji at resistance. High 1s are good when you're early in the market cycle. Here's a strong leg 1, pull back, and then here's a high 1 buy above bar 6. Really the high 1 is somewhere between bar 5 and 6 on a smaller time frame. So then here, and now it's a leg 2, and we're at resistance. So this is a much different high 1 than down here. And then a bear bar closing on its low, bar 14, after 2 legs up at resistance. We might test lower. I said bar 5 was the start of the channel phase. Breakout, pullback, channel. It's a tight channel, that's true. But like I said, it's 2 legs up at resistance. We're so far above the average price, bulls might wait to buy lower. Now we have a bear bar closing on its low. That's enough of a reason for bulls to exit below. And then consecutive bear bars, 14, 15. 15, a fairly big bar. Big enough surprise. It's probably a leg 1 and probably going at least a little bit lower. The first reversal attempt is likely to be minor. 16, an inside bull bar. Some traders will see this as the high 1, but you're buying a high 1, now high in a trading range. You have bulls who are buying all the way up. They got trapped on bar 12 or 13. Now this line is resistance for a couple of reasons. It's the leg 1, leg 2 measured move, and then you have trapped bulls above. So probably more sellers above, plus 16 is an inside bar. So that lowers the probability as well. And instead of trading above, we're going straight down. Traders sold the close of 16 and then 17, a shaved bear bar. Some will argue it's 2 legs, 1, pull back 2. It's an implied 2 legs because 16 is an inside bar, so no technical pullback on this time frame. So other traders will see this all as 1 leg, and then we can get a pullback, and then a bigger second leg. The market looks like it's converting into a trading range. At this point, there are many more bull bars than bear bars. That is true, but if you look at the bear bars, strong bull trends don't have bars like 14, 15, 17, even bar 5. It's a strong bear trend bar. So there's a decent amount of selling pressure in here. And I think at a minimum, we'll test the bar 5 close, the start of the channel, possibly the bottom of the trading range. Now look where bar 17 is testing. You had bears selling above the high of bar 8, betting maybe 1, 2, maybe 3 pushes up if we trigger the sell, and then they're trapped on 9, 10, 11. So what do you think those bears will do when we get back to this price? 15 tested it, it bounced. 17's testing it again. and then we bounced again. 18, a small bull bar. Some traders will see it as a high too, but it's tight enough down that it's really just one leg on a higher time frame, and the first reversal up is probably minor. It's also a small bar, so low probability, small risk. There's an increased chance we trade below 18, so if you buy above 18, better to use a wide stop. Now, the wide stop for the bulls is probably below bar 6, the last major high or low. You can see we rallied to it with a strong breakout to a new high, but the problem with the stop placement here is you know that if the market is in a trading range, there's going to be more buy orders here. And bulls might wait to buy lower rather than here if they think a couple of strong bear bars probably going lower and there's a magnet here. So then 19, we had a doji. Does 19 look like bulls were eager to buy? Of course not. It basically went sideways. So for stop order bulls, if they did buy, fairly disappointing entry bar. By the close of bar 18, there's an 80% chance we've seen the high or the low of the day. At this point, because of distance, we're closer to the high of the day. Maybe there's a 40% chance we've seen the low. Maybe 30% chance we've seen the high. But if you think about context, if this is a trading range day, maybe we'll test the high one more time, but there is a chance we come below bar 1. Remember, bar 1 remains the high or the low of the day, only 20% of the days. And if bar 1 was going to remain the low of the day, it would have to be either a bull trading range day or a bull trend day. And at this point, it looks like we're going more sideways. We also have a trend line break. So bull trend, bears got a trend line break. We might get a retest of the highs. I'll redraw that price before a major reversal down to here. It is 2 legs down, so some bears may exit above 18, some bulls may buy, but again, 19, fairly disappointing. And then going a little higher on bar 20, but these bars are small, and it's possible this is a bull channel on a smaller time frame, so bear breakout, and then a bull channel that's a bear flag, maybe a little more to the downside. Bulls who bought the close of 16 front running the buy, they got trapped on 17, so any bounce they may use to exit, and 17 may have been strong enough for a second leg, so bears will short on the pullback, bulls who are trapped will exit. And that's what's happening on bar 21. 21's a small second leg. So we finally had a pullback here. Micro channel from bar 13 to 18, and then a break of that channel, then a small second leg. But 3 consecutive bull bars, that's disappointing enough for the bears. They may exit at a new low. We also are testing lows to the left. This might be the low of the trading range. So it might be 1, 2, 3 legs down, maybe a wedge bottom in the trading range. Maybe support below. 22, we tried to break out below 21 but failed, and 22 reversed up and closed on its high. So possible wedge bottom, 3 pushes down, and then a bull reversal bar closing on its high. It's a good signal bar, so the bulls might have room for a scalp to the upside, but I still think the upside is limited. What do the bears do? They'll probably exit shorts above bar 22. There's too much of a risk that we rally to the top of the trading range. But if the follow-through is disappointing, bears might enter again. But it's really the middle of a trading range. Not ideal to be buying or selling in this area. 23 is a fairly disappointing bar for the bulls. We tried to break out above bar 20. Maybe it's a double bottom, break above the neckline, go for a measured move up. But the breakout was weak, and it closed below its midpoint. It's a fairly weak bar, and fairly disappointing. But on the flip side, 23 is a low 2. Bear breakout, pullback, low 1 below 20, and then low 2 below 23. But consecutive bull bars, the odds are there are buyers below, and this is the bottom of a trading range. And then 24, you can see we tested below 23 and reversed up, but 24 closed a doji. So now we have a trading range bar and a high 1 at the top of a small trading range. And even if this is an overall trading range, we're in the middle of the range, so the upside is still limited. So probably more sellers above 24. And then bear bar 25, trader sold to close. We did not go above it. So 25, probably more sellers above bar 25. Maybe it's all a big leg 1, complex pullback, maybe 2 legs, and then the bears get more to the downside. 26, we had a tick gap, so from the close of 25 to the open of 26, we gapped down. Now we have consecutive bear bars, but both with prominent tails. The market's in a tight trading range. It's a limit order market, probably sellers above, but the sellers above 26 may not come in until above 25 or even 23. And to the downside, probably support below 22 and at the moving average. And it looks like we did have sellers above 26, and 27 went outside down. But the problem with 27, we have 2 legs down. So from the high of 23, maybe leg 1, then a pullback, leg 2, and it's also maybe 1, 2, 3 legs down. So a couple of reasons. Traders, maybe bears are looking to take profits in this area, and bulls will look to buy. You also have the moving average just below. And then 28, bear breakout attempt, but testing the moving average, and still within the range of bar 22. So bear breakout, but you have to ask, bear breakout of what? Really just this bar, and I guess the bars to the left, but that's a breakout attempt of a channel line on a smaller time frame. And that's a low probability event, so there's support for several reasons here. Now we have leg 1, pullback leg 2, maybe a high 2 above 28 at the moving average, and a double bottom with 22. Might be an overall bull trend, complex, maybe 3-legged pullback to the moving average, and a wedge bull flag, and we could rally. Outside bar 29, so we tried to get a bear breakout below the moving average, below 22, and we failed. It immediately turned up. But the problem with 29, it's a big bar, so big risk, and it's just a doji, so it's a trading range bar. Usually more traders want to sell above a trading range. So what about selling above bar 29? I would not, because the context is bad. You're in the middle of a tight trading range. So I think for buying and selling, if you're buying on a stop above 29, you're forced to buy in the middle of a tight trading range with a fairly big bar, so big risk. It's a bad trader's equation. As far as selling above, traders will probably wait to sell higher. Bull bar 30, but overlapping all the bars to the left. Market's in a tight trading range, and it's breakout mode. Also, remember what I said coming into the day. On days when there's an FOMC report, market's usually more quiet, and you have these tight trading ranges. These are common. 30 is a low 1 sell signal bar. It's a bull bar, consecutive bull bars. You can see we traded below and found buyers below. But if you bought below bar 30, 31 is a fairly disappointing entry bar. The market is reacting to the moving average. We're above it for over 20 bars, and then once we tested it, we're bouncing on it, failing to break below, failing to break below. There's buyers at the moving average, probably going at least a little higher, but there might be sellers above bar 31. It's a weak buy signal bar in the middle of a tight trading range. 32 traded above 31, but it's a small bar, basically a trading range bar, and a weak breakout attempt. Market's deciding, and you can draw the triangle several different ways, but the point is the range is contracting, it's breakout mode, and because we had a bull trend before the triangle, there's a higher probability we'll break out to the upside. But even if we do, we're still within the overall trading range, so this might be resistance. And we've been sideways for enough bars, the probability might be 50-50. Bear breakout attempt 33. It's a strong bar, but it's not especially big, and it's not breaking out below much. The bears need to do more here, and whenever that's the case, bulls will buy the close. and then disappointing bar 34. So if a bear was short, they'll probably exit maybe on the close of 34. Maybe 33 will get a small second leg down, but it's so minor, it's hard to catch that second leg. As far as buying above 34, I would not. The bar closed below its midpoint, and it's the middle of a tight trading range. Trading with stop orders is never a good idea. And then we went outside down 35. So the bears break out 33, pause bar, second leg down 35. 35 is a strong enough bar, we might go a little lower. There's probably less traders buying above than selling above. So that will reduce the number of buy orders. And on the close of 35, there might be buyers below, like bar 29, but we're approaching this magnet, the close of bar 5 and the start of the channel. Probably test it before we turn back up. And then 36, consecutive bear bars. 36 closing on its low, but it's a smaller bar than 35. Bears might see this as a bear breakout of the triangle, but does this look like a bear breakout you're eager to get short in? Probably not. It's really just small bars, mostly overlapping each other, and it might be, I'll redraw it this way, might be 3 or 4 legs down. Trying to break out of a bear channel, but near support might be more buyers below. Bull bar 37, but closing below its midpoint. First reversal, actually second reversal, so we reversed above 34, pulled back, reversed above 36, pulled back. The bulls want a strong signal bar. But so far, the stop order is triggered above weak. This is a bear bar, this is a weak bull bar. 37, probably more buyers below. It's a weak sell signal bar at support. And then a weak breakout attempt on 38. Market might be in a nested wedge bottom. We have maybe 1, 2, 3, 4 legs down. And then in here, bear breakout 33, pause, breakout to 36, pause, breakout attempt 38, but just one tick and pulled back. The signal bar isn't great, but the context is pretty good. It's nested wedge at support. And then a bull breakout 39, crossing the moving average and closing on its high. That's good for the bulls. Probably strong enough for a second leg. Some traders might argue 37 is leg 1, bull breakout, pull back, second leg here. But the reality is we're probably going at least a little bit higher. 40 was a disappointing bar, but do you really want to sell below bar 40? It's completely above the moving average, and the downside's limited. You have trapped bears who sold above bar 38, they got trapped on 39. That's going to be a support level. And 40 is a weak signal bar, it's a doji. Bear trend bar 41, but we're testing where bears got trapped. The bears still need to do more. And then traders bought the close of 41. 42 completely reversed 41, 2-bar reversal. Maybe leg 1, pull back, and then the start of leg 2 here. Bull bar closing on its high. In the lower part of a trading range, it might go a little higher. And then 43, another bull bar closing on its high, consecutive bull bars. Strong enough breakout will probably go a little higher, but you have to proceed with caution because it's 2 legs up, 1, pull back 2, in a trading range. You look to the left, what happened last time the market was at this price. There's resistance here. Bear bar 44, so the bulls, maybe a buy climax, pull back, buy climax, pull back, or pause bar. Might be a little more to the upside, but the upside's probably limited. These look like legs in trading ranges instead of legs in a bull trend. At this point, if you ask yourself, is the market going to create a new high of the day or a new low of the day? It might be 50-50. The bulls have the argument with the gap up and the rally on the open, but we've been sideways for enough bars. The breakout direction could be up or down. Also, the daily range so far today is less than 30 points, so that's below average. So the daily range could still get bigger. Wouldn't be crazy if it stayed around 27, but that is something to note. The recent average is more like 40, 45 points. High one above 45, but you'd be betting on a third leg in a trading range. 1, pullback 2, pullback 3. Some bulls, maybe they buy some kind of pullback after leg 2 and look for a scalp into the third leg, but the upside again might be limited. Outside bar 46. Remember, outside bars are trading range bars, and when you get a trading range bar within a trading range, you want to trade it like a trading range, so probably more sellers above, buyers below. And then 47 broke out to the upside but found sellers. Now this is another nested wedge pattern. We have 3 pushes up from 40, 43, and 47. 1, 2, 3, and then the last 3 bars of the wedge are also a wedge. Up on 45, down on 46, up on 46, down on 46, up on 47, reversing again. The signal bar isn't great, but it is a second reversal. We triggered the sell below 45, went higher, and then sell orders below 47 would be a second reversal, and it's a nested wedge, maybe at the top of a trading range. Bulls probably exit below 47. This is a really tight trading range and limit order market. Traders are not swinging in here. I haven't mentioned always in a while, and that's because it's a tight trading range. Traders are buying low and selling high. Outside bar 48. The bulls tried to get a breakout. It might have been a parabolic wedge. And then you can see we reversed fairly strongly on bar 48. Enough of a surprise, probably going at least a little lower. And it's 3 legs up, so it might be the start of a bear leg. And then we can see we had a bear breakout at 49. But what happened? We tested support to the left. We tested the bar 5 close, went a little lower, and found buyers. And the bar closed above its midpoint. Market's clearly in a trading range. 48 and 49 were strong enough that they'll probably get a second leg, but some traders will also view it as a second leg itself. Depends on where you start it. Maybe from this swing point, leg 1, wedge bear flag, leg 2, it's a bigger, sharper second leg, possible second leg trap. But it's a big enough breakout. You had bulls buying below bars. They're trapped on this breakout, probably sellers above. Inside bar 50, you can see it rallied and pulled back, testing a breakout point, maybe testing the low of 46. So here's a low of bar 46, which is an outside bar, which typically get retested. We broke out above the outside bar, immediately reversed, broke below it, tested it again. But remember, this was strong enough for a second leg, so traders might be selling here for a second leg down. And then 51 might be the second leg for the bears. It's a strong bar, but it's still within bar 49, and so this could be a double bottom. Here's one low, pull back, second low if we reverse up here. And 52, an inside bar and a possible high 2. On this chart it's a high 1. This is a micro channel, but a bull bar closing on its high after 2 legs down, maybe nested 2 legs, bottom of a trading range, probably going at least a little higher. And then an outside bar 53, bull bar closing on its high, consecutive bull bars. Disappointing for the bears. And you can see what happened on 53. If a bear was short on the close of 51, they got 52. That's a disappointing bar. And they used the tail on 53 to exit at break even. 53 tested the close of 51 and reversed up. So probably going a little higher. 54 tested the moving average and reversed down. Because this was a micro channel, we didn't have a pullback until above 52. This might be leg 1, pullback, maybe leg 2. Also look at the time. This is the 2 o'clock bar, Eastern time. and this is the time of the FOMC report. And so at this point, usually better to be flat 15 minutes before the report, and wait for the report, wait for 15 minutes after, wait for more information, and then reassess. So at this point, the volatility could increase, and it could be a breakout to the upside or the downside. But it's good to be aware that this is the time to be flat and expect that breakout. Then a huge bear breakout, 55, but a huge tail below. You can see we broke out below bar 1, so in this case, bar 1 did not remain the low of the day. Now we might have leg 1, pullback, leg 2, second leg trap. Overall, this is a trading range day, and so you had traders buying below bar 1. And you can see we rallied into the close of bar 55, so that's a disappointing bar for the bears. 56, an inside bar and a bull bar, but a prominent tail. Lowers the probability for breakouts, probably sellers above and buyers below. This was a big enough breakout, even though it failed at the low of the day. Big enough breakout, any pullback will probably lead to a second leg down. You can see where 56 is testing. We had breakout points here. It closed this one, or it tested this one below 49. Breakout below the 49 low, retested here, but there are still other ones above, like here. We tested the 54 low, is another magnet. $57 broke out a little higher, but really weak bull bars. Big tails above and below. 57's a doji, more likely sellers above than buyers. What about selling below 57? I would not. There's probably buyers below 57. 58, we're vacuuming up to the upside, but 58's a breakout attempt and failing right at the high of 55. We tried to break out at 55 and failed, and we're closing at the moving average. These three bars are a wedge on a smaller time frame. Rally on 56, pull back, rally on 57, pull back, and then the biggest bar of the three, it's a parabolic wedge. It's climactic, it's testing resistance, and there's probably more sellers on the close of 58, high in a trading range, and 3 pushes up. 59, a bear bar. Now this might have been strong enough up from the low of 55 up to 58 for a second leg. So 58 might be, or 59 might be a minor reversal, but it's disappointing enough that bulls who were long here on the close of 58 will be disappointed with 59, and they may look to exit on any bounce. Outside bar 60, 2 legs up for the bulls, and still this bear breakout was strong enough for a second leg, which we have not had yet. In trading ranges, breakouts get deep pullbacks. This is the deep pullback. We pulled back beyond the breakout point, but we've gone above it twice and found sellers twice. Now we have a wedge for leg 1, and then leg 2, just a single bar, and it's an outside bar. There might be sellers above, and then a second leg down. The moving average is flat. Market's clearly in a trading range. Look at all the overlap and sideways price action. 61, another outside bar, so it's outside, and that's a breakout mode pattern. You can see where we tested the bar 47 low. Bulls who bought below 47, trapped here, never got a chance to exit. They scale in lower, and they finally get a chance. Trading ranges are forgiving. So if a bull did buy here, used a wide stop, scaled in lower, they would have been able to avoid a loss. Might be 2 or 3 legs up to bar 61. Maybe 1, 2, 3. Testing an area where bulls got trapped, so there might be resistance and more selling here. But overall, it's really sideways. And when in doubt, buy low and sell high. So sellers above 61. And the problem with buying below is that the bottom of the range could be down here. We traded below 61, fell lower, tested the close of 55, and then reversed up. Without context, 62 is a strong looking bull bar, but the body is smaller than the tail, and you can't just ignore context. When you consider context, it's 1, 2, 3 legs up with lots of overlap, high in a trading range. We might go a little higher, but there's probably sellers above 48, sellers at the high of the day. And there might even be sellers right above because it is 1, 2, 3 legs up, and then this resistance area here. And we traded above 62 and immediately found sellers. Big bear bar 63, but completely overlapping 62, probably buyers below. It's a tight trading range, limit order market. Consecutive bear bars, but they're weak. Tails below, might be 2 legs, might even be 3 legs. 1, deep pullback, 2, deep pullback, 3. And now we're low in the range. Doji 65. Easier seen on a smaller time frame, but this is a wedge and a double bottom. Probably going a little bit higher. This is a support area. 66, vacuuming up. All these breakout bars in here, Brad calls them emotional bars. When you get these big bars, these breakout bars in a trading range, you know there's a problem. When the market's sideways, all the bars are overlapping. And if you're looking for always in, and the market can shift from always in long to always in short with one bar, you know it's not a strong trend. If that wasn't obvious, that's one way to gauge that. But it's pretty clear here. Who's in control? It's pretty 50-50. And so in this case, look to buy low and sell high. 66 is a big bull bar after a possible wedge double bottom. And it might be the start of a first leg up, might go a little higher, but remember, there are sellers above. 67, another bull bar, so weak sell signal bar, consecutive bull bars. It's a double top with either bar 60 or bar 48, but it's a terrible sell signal bar, so probably buyers below. And then an inside bar 68, high one, but probably sellers above. But 3 bars without a bear bar, and micro channel since 65, the first reversal down might fail, and we may go higher. 69, a bull bar closing on its high. The micro channel continues, but this is weak context, and the micro channel itself is pretty weak. The bull bars have tails above, overlap, a doji bar, and just look at the context. It could easily be 3 pushes up, high in a trading range. So in this case, probably better to look to sell here. And when I say sell, I mean sell out of longs. There's no reason to sell yet, unless you're an aggressive trader and you're selling with limit orders maybe above swing points, like 48, but you need to use a wide stop and scale in higher because this momentum is strong enough to keep going, and we could easily test the high of the day. 70, another bull bar. So micro channel since 65, but the context is still terrible. The bulls are finally testing the high of the day, and it's bull breakouts, but these breakouts are minor, and there's no breakout until there's a breakout. So the bulls still need a breakout of the high of the day, and then they need follow through. And so this is a bar that aggressive traders might sell the close of, because now they have a couple reasons to. You can see we're high in the range. We're testing the high of the day. It's 2 legs up, 1, pause, 2. And the swing point, bar 65, was a weak buy signal bar. So we'll probably come back and test that price right here. And then look what happened on 71. That's really interesting. You can see we broke out to the upside. We broke to a new high of the day by a couple of ticks, and then immediately reversed down pretty violently. And look where the bar closed. We closed 1 tick above the high of 65. Very interesting. And then, of course, big enough bar, big enough surprise, probably going lower. Maybe the low of the range is down here. We test lower. We even go to a new low of the day. But is this going to break out into a strong trend? Probably not. More likely, it's a trading range and maybe an expanding triangle. Different computers draw it different ways. Maybe it started up here. But in any case, this is probably a sell vacuum test of the bottom of a trading range. Disappointing bar 73. So bear breakout to a new low, but did not close at a new low. And then more disappointment, 73. 73 is not a strong buy setup. It's a strong bear leg down, and then a weak buy signal bar. So there's probably more sellers above. And the first reversal will probably be minor. And then there were sellers above on 73. Above 73 on bar 74. The problem with bar 74, you're getting a low one sell setup, but the bar is big, the tail is bigger than the body, and the biggest problem is context. You're selling at the bottom of a trading range, maybe the bottom of an expanding triangle. So you have big bar, so big risk, bad trader's equation, low probability because of context. When there's that much wrong with the trade, and you have a bad stop order trade, you know it's a good limit order trade. So probably more buyers below. And that's what happened on 75. Now bar 75 is a second reversal up. And even though it's a doji, the bulls at least got it to close with a bull bar. And it's a second reversal at the bottom of a trading range. So bears will probably exit above 75. Aggressive bulls might buy. Bull trend bar 76. Vacuuming up, but we have the moving average, resistance, and bulls might scalp out in the middle of the range. And I'll just draw the approximate middle of the range. I'm just curious about that. So this red line is 50%. And then look at 77. We tested 50% of the range and found profit taking. It's a combination of bulls taking profits and bears selling. Bears selling what? Big breakout, 50% pullback, looking for a second leg down. The rally is weak. Look at the bull bars. It's a doji, climactic bar with big tails, trading range bar, small body, big tails, and resistance at 50%. So bears might be selling here, looking for a second leg. Minimum test might be a test of the high of bar 75. 78, we went a little higher and then reversed down. Leg counting gets confusing in here because there are a lot of implied legs. In here, you can see it as one leg up by the bulls, or you can even see it as three legs, maybe up on 75, pulled back, up on 76, pulled back, up on 77. So this might be a wedge, and then we went even higher, a fourth leg, even lower probability, and then reverse back down. And you can see where we're testing the signal bar, the stop order signal bar. And then 79, testing a little lower, but it's a small bear bar with lots of overlap with the bars to the left, and we're low in the overall trading range. So then a bull bar on bar 80, but it's an inside bar, reduces the probability. And there's just one more thing. The open of the day was important because it's a trading range day. And you think about the gap up in the context I was talking about in the beginning of the video. Traders are paying attention to the open of the day. The bulls, at a minimum, want to close above the open, and they have one more bar to do it. And you can see they did it on bar 81, closing just above the open of the day. But basically, you can see on the daily chart here that it's a trading range day, and basically a doji. For always in today, I thought it was always in long because of the gap up, even with bar 1. And if it wasn't, it was clearly always in long on bar 3. And No reason to sell really until bar 14, a bear bar, closing on its low. I think we remain always in long, but at some point this becomes an endless pullback, and it's really a trading range. I drew a triangle earlier. You can also view it as a triangle. But the point is, it's a breakout mode situation. It's a trading range. So buy low, sell high, and always in is opposite. And for the rest of the day, it was still a trading range for the rest of the day. So as far as always in goes, you can think about it. If you think about always in for trading ranges, it's like opposite day. So you get a big bear breakout, but probably at that point, always in long. You get a rally, but then always in short. Another big sell-off, always in long. A big rally, always in short. Big sell-off, always in long, and it's backwards. And so in general, instead of thinking about always in trading ranges, that's why I just think buy low, sell high. For stop order trades today, I thought it was reasonable to buy above bar 2, buy the close 3, buy above 3, and then you could buy above bar 9, but might be getting late. And then I thought 12 was climactic, probably take profits, so that combined with the bar closing on its low, reasonable to sell below 14, but at that point, more likely a minor reversal, so more for a scalp. And then all through here, more of a limit order market. One of the stop orders I thought was reasonable was buying above bar 38. Nested wedge bottom, I'll draw that again. So you have different computers drawing it different ways, but the more ways you can draw it, the better. So I have 2 drawn there, and then you can see, even in here, 1, 2, 3. So there's several ways to draw it. And then you're low in the trading range, probably testing higher, that you could buy above here, go for a test of some resistance area. And then even if you were just trading with the current price action, what'd you get out of it? 1, 2, 3, look to exit on the third leg. And then here I thought 48 was another reasonable stop order trade. After 3 legs up, strong signal bar, high in the range. But that's again another scalp and getting close to the report, so I'm not sure. And then for stop orders, for the rest of the day, I really don't like anything in here. For limit orders today, buyers below bar 4, the first reversal, probably going to fail. Buyers below 8, it's a minor reversal. And then maybe buyers below 13, but if you get 14 as your entry bar, you got to exit. And then all through here, lots of overlap and trading range price action. It became a limit order market, buyers below bars, sellers above bars. So if we go, you can see we're testing below 18, buyers below. Decent bull bar, but limited upside, probably sellers above 20, and there were. And these are for scalps. Strong enough leg up, buyers below 23, and there were, but it was a really quick trade. Sellers above 25. Here's actually a wedge, or you can call it a stairs pattern. Breakout below 15, reversed up. Breakout below 18, reversed up. Breakout below 22, reversed up. And then I mentioned the stop order trade. This is an area where traders might look to buy with limit orders, like below bar 29. And then on the way up, buyers below 40. And then at this point, probably sellers above bars, getting high in the range, 1, 2, 3 legs up. Buyers below here, again, but big enough breakout that it's disappointing, probably lead to a second leg. So sellers at the breakout point here, second leg down, but 2 legs down in a trading range, buy the close 51. And then there's the report bar. And then all through here, it became a trading range. So buyers down here, sellers up here. Buyers below bars, sellers above bars, all the way for the rest of the day. Please feel free to leave questions in the comments and include timestamps. And with that, I hope everyone has a good rest of their night, and thank you for watching.